Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth Hand and Stan Miller will help you with growing your practice and your clients' peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome back to the Legacy Leaders Podcast. This is your host, Stan Miller. I'm really glad to be here today with our guest, Chris Vermeulen. Chris is a Canadian guy. He's an entrepreneur, an inventor, an investor, a technical analyst. He's got some great stories. He has my attention because he says some things about how to manage our money that really grabbed me. And what grabbed me first is I noticed on his bio that he has Larry Williams endorsement. Many of you may recognize Larry Williams. He's the guy that Jim Cramer quotes all the time whenever he really needs somebody with real authority. And he's endorsed Chris's work. And Chris, you told me a little story before we started recording about how that came to pass. Would you mind sharing that again?
Yeah, sure. Well, thanks for having me on the show, Stan. Yeah, long story short, I raised in an entrepreneur family, and I was 16 years old in high school, and I decided I wanted to do business because I always wanted to be a CEO. I'm like, I'm taking business, and through business, you got to take a finance class. And this was the class that we had $100,000 of play money. We had a semester. We had to try to beat other schools and see who could make the most money trading the stock market. And we made like $180,000 in a semester, which was like throwing darts at the newspaper more or less back then. And I thought that was the coolest thing ever. And through that process, my dad happened to get this little marketing booklet about trading futures from Larry Williams. And I read this thing from front to back, I don't know, dozens of times. It was just so amazing. And I was like, holy cow, I could make like $50,000, in a week trading, pork bellies or something. So I told my dad, I'm like, we got to open a futures account. Let's do this. And he kind of laughed at me. He's like, well, you keep learning and do your thing, but we won't quite go that route. And then fast forward several years later, 2014, I wrote my first book called Technical Trading Mastery, 7 Steps to Win with Logic. And I called up Larry. I said, Larry, I've been following you forever. You got me into this. Your booklet like sucked me right in as a kid. I started trading, when I was 16 years old. My dad co-signed for my account. Back then I was trading with E-Trade. And I said, I'd love you to read my book and tell me what you think. And he ended up endorsing it and writing a nice blurb on the back cover of the book. And so that's how I kind of got into it. And Larry really was kind of the push or the draw to pull me into the space.
Well, pretty incredible to have Larry as a mentor. Pretty amazing, actually. So one of the things I know that you say is that what we're being told about how to invest is quite often is wrong. Is that a fair way to tee up how it is you approach a conversation?
Yeah, in a nutshell, it's pretty blunt. But yeah, so I mean, everybody obviously sees the markets a different way. And I'm a big part of, I think, trading and managing your own money is knowing your personality type. And maybe we'll get into this later with the Myers-Briggs and knowing, your style, your personality test. But I'm very logical. I'm all about logic and efficiency. I want to make everything work. It has to make sense. And so when I look at like the stock market and the way people invest, there's 2 core ways that everybody invests. They either do the buy and hold strategy, and I guarantee you're going to go through one hell of a roller coaster over the next 40 years. And I guarantee you will never retire 20 or 30 or 40 years sooner with that strategy. It takes time to make money. And then you have the other side that are like super active traders. And there's been all kinds of studies across North America, Taiwan, and Brazil that say 97% of active traders who actively trade for 300 days or more lose money. So, I mean, I've been in this industry forever. I've ran active newsletters and day trading rooms and all that stuff. It is a rotating door because emotions get in the way. A lot of people don't have the right personality and they don't get the right help. But overall, I mean, that's in a nutshell. You've got to understand what you're doing when it comes to this market. And when I look at the efficiency, as you were talking about, Stan, those buying and holding, like you go through these giant bear markets and you can go 5, 10, 15 years without making any real money. Like from the tech bubble, it took 16 years from the NASDAQ to come back. That's twice you lost over half of your money. That's 16 years of not making any returns at all. And so it just delayed your retirement by at least 16 years. And of course, you're going to have a much smaller amount of money. So I'm like, well, why can't we follow price action that if it's going down, we can benefit from it and then profit during the entire time? So my whole strategy is based on only holding an asset class, one asset class at a time that is going up in value. And so, I mean, this kind of opens up all kinds of different things, but I just don't think we should be holding when things go down. We're investors here. We're not investing in something going down. We want things to go up in value. So if it's not going up, I don't care how much we love it. Let's just get out. We can buy it back later when price is going up. And I flipped from a fundamental trader back in 97 to about 2001. I was trading fundamentals, trading companies with growing earnings. And you realize, hey, it doesn't matter how much these companies are actually growing. The stock price still got cut in half. And then we get cut in half again during the bear market. And I'm like, well, fundamentals are garbage. It means absolutely nothing. And we can use technical analysis, which John Murphy, he's like the godfather of technical analysis. We can follow trends. We can identify them. And if you understand all the different levels and ways to analyze the market and money flows and sentiment and things like that, then we can very clearly identify, is this a strong wave? Is this a beautiful trend that we want to ride? Or is it something we just sit back and relax or go find a different asset? So that's kind of, I don't believe the buy and hold is a very good way. In fact, I call it more or less the retirement ticking time bomb, because majority of people are retired or very close to retired. They have the most money they've ever had. And the market is good at doing one thing, applying the most pain to the largest group of market participants at the worst possible time. And I believe like we're coming up to that. And there's all kinds of things. I just was at the Money Show doing a 2-day event in Toronto 2 weekends ago. And I talked about all this stuff. The economic data is breaking down. Everything in the stock market is breaking down underneath the hood. It's all camouflage, which the market is great at covering up. So anyways, there's a whole lot to talk about. So I just focus on a strategy of riding one wave, one asset at a time.
That sounds radically different from make sure that you're diversified.
It is. It's completely different. Yeah. Yeah. So, I mean, I like to look at the stock market. A really good high level view is like, I'm a surfer. I love the ocean. I live on the water here. Look, you have to look at the stock market like the ocean tide. When the tide goes up, it lifts all boats. When it goes down, they all go down. The stock market is pretty much the same. It doesn't matter if you have like a whole bunch of sector ETFs or a whole bunch of stocks in different sectors. They're all boats. And when the stock market tide is going up, you can really just kind of throw a dart and naturally they'll all kind of go up. When it's going down, it doesn't matter how many you have. Some might do okay, but the majority are going to lose value and you want to be out. So this is a big thing is people think, well, I own all kinds of sectors and I've got a huge mix of stocks, but it's all the same trade. If you own equities, the equities market is either in favor or out of favor. And people don't realize that. Being diversified with a whole bunch of smaller positions in stocks actually adds way more risk than they expect. And when the market does go down, they actually get hit way harder than just doing like an index investing strategy where you own the index when it's going up and you get out of the index when it's going down and wait for the next bull market. So yeah, there's a lot of different ways to do it. And I don't believe in holding them when they're going down.
So you're not always into equities. You're into other things too, I guess.
Yeah, so I have like an asset hierarchy. So at the top of the hierarchy, there's 4 key asset classes, which are we want to be long either the stock indexes, the US indexes. If they're not favorable, then we go to the US long-term treasury bonds. And if they don't meet our criteria, then we'll go to the US dollar index, which it doesn't matter if the dollar index is rising or falling, there's an inverse ETF. So if there's a trend in the currency, we can continue to profit from that. And then if nothing meets our criteria, then we'll just sit in a BIL ETF, which is like a cash equivalent position. You just earn daily interest and a monthly dividend. So there is no downside risk. We just let the storm kind of settle and wait for one of our assets to kick back into gear to give us a clean signal. And I didn't quite finish my story before about the ocean. So the next level from the tide, Stan, is picture yourself walking down a Florida beach. And you see surfers floating out past the break, talking, chilling out. What are they waiting for? They're waiting for that set of waves to roll through so they can hop on. The stock market has like 5 to 12 waves that roll through our assets every year. And so we are literally just surfing the markets. We will sit in a cash position with no downside risk about 40% of the time of the year. So you really have like a lot of stress reduced because you're just earning daily interest with no downside. And then when a wave rolls through one of these asset classes, we just hop on with an ETF and we ride that whole sector, like the SPY or the QQQ. We ride that wave. And the nice thing about catching a strong wave when everything is in line, telling us there's huge momentum here, is we also know when a wave is starting to weaken. So we can trim off profits, we can move our stops up. And then when the trend finally reverses, we just hop off and we move to the next asset in our hierarchy or just move to cash. And our hierarchy, as we go down to those different assets, each asset moves slower and slower. So typically the markets are getting crazier and crazier, and we're going to slower and slower moving assets to make sure our money isn't volatile. We still want to earn money, but we don't want to move into anything risky. We want to downgrade our risk. So reduce our risks.
So how do we know? Where do we look? What do we know? How do we know when the market's rising? What's the data point that we look at that we can trust to let us know if rising or turning now to fall?
Yeah, I mean, there's quite a few to it. Like you need to understand. I don't know if you ever heard of Stan Weinstein. So he teaches in his book How to Profit from Bull and Bear Markets, 4 stages that the markets go through. I could actually show some images if we share screen. I don't know but if people can see that, but there's 4 stages, and you need to identify what stage you're in.
By the way, we can share screen. We do have people who watch this on YouTube. Not a lot of people consume this podcast in audio, but we do. They can watch it. So I don't know if you have that handy.
Sure, yeah, I can show you a really good visual here. I'll try to talk about it like you're not looking at it for those listening on a podcast right here. But more or less, there are 4 stages to the stock market. And each stage requires you to have a different strategy. And the problem with most people is they have one strategy, which is like buy low, sell high, or buy high and hope it keeps going higher, which works well in a stage 2. Stage 2 is a bull market, an advancing stage. We all love a stage 2. I believe right now the stock market is in a stage 3 topping phase. This is volatile, very difficult to trade. Most stocks have been in this stage since about March of 2021. The indexes have kept going higher with camouflage, which I mentioned earlier, with the Magnificent 7 stocks, the AI, dragging the indexes up, making the market look strong. But if you remove those and look at the stocks as a whole, they have this chart pattern of a stage 3 topping phase, which is the markets are all over the place. It's actually been going sideways. It's had a big top and a big correction, and now they're just trading sideways before they go into a stage 4 decline, which is like the 2008 financial crisis, the tech bubble, you name it, every previous financial crisis is a stage 4. And so we're getting very close to that. And a stage 4 and a stage 2 are both very strong trends. It's either a strong bull market or a bear market, a rising tide or a falling tide. Both of those, we can make a ton of money. Markets fall about 4 to 7 times faster than they rise. So there's some pretty significant gains that can be made when the tide changes and we go into a stage 4. Most people lose their shirts, but you can identify it using simple, you were asking, how do we identify it? A really good way to do this is put the 150-day moving average on the SP 500 equal weighted ETF. And then you can more or less, if price is above the 150-day moving average and the moving average is sloping up, then naturally you're probably in a stage 2, in a bullish phase. When price starts to break through the 150-day and starts to break below it, or the 150-day starts to flatline or roll over, you're either in a pause before going a whole lot higher, or you're in a stage 3 topping phase. And then we're going to start to break down. And so I believe, are in a stage 3 this time because economic data is slowing, business earnings are slowing. There's all kinds of things coming together in terms of what different sectors and commodities are doing. When precious metals outperform, utilities, energy stocks are at all-time highs, industrial capital goods are at highs. This is generally when we're in like a major stock market cycle top. So these are all early warning signs. The gold chart is one of the best barometers of what's going on. The price action we have right now is almost identical to what happened in, let me just see if I have that chart here. I don't think I do, but in 2008, just before the big crisis. So we have all these things coming together telling us about this. So there isn't like a simple way. We have to look at money flows between different assets There's risk on assets, which are like stocks and small cap stocks, tech stocks. There's risk off assets where people move to utilities because we're always going to need electricity and running water. No matter what happens in the economy, they'll buy consumer staple companies, all of that stuff. So that's kind of, in a nutshell, how we like to look at this stuff is track this type of data and follow the money flows. And that gives us an idea of what's going on.
So you wrote this book. The most recent book I think you wrote is called Asset Revesting. And that word revesting is not a word I've ever heard. So maybe you can shed some light on what does that mean? I think that's a word you coined, right?
Yeah, I mean, so what I'm trying to make available to people is like a different style of investing. And I call it asset revesting because we're constantly reinvesting in a different asset. So when one asset falls out of favor, we reinvest into another asset. And so, you got the buy and hold, you got active trading, and you have asset revesting, which is moving into whichever asset and reinvesting our capital into those. And so that's kind of how I kind of came across with it. It's just different. And that's kind of the whole core is let's just hold assets that go up. And if it's not going up, who cares? Let's just get out of it and move to something else.
So tell me about your business. You manage money for people? Or you write books and talk about it?
So I do a lot of different stuff. Business, obviously, it's a newsletter business, so people subscribe. I do not manage money. They copy the trade. So this whole strategy is a strategy that I've been trading since 2001. It keeps evolving and becoming even more efficient, more effective. But all I do is I manage my money and I send those out to my subscribers saying, this is what I'm buying. I tell you the ETF, the portfolio allocation, you just copy my trades. I tell you where the stop is, where the targets are. I update each day in the morning or twice a week, depending on how active you want to be, just to follow the info. So it's a subscription newsletter business. Got investors in 130 different countries, financial advisors, a whole bunch of, you name it across the board. So it's a great business. I love it because it's what I need to do. And I get to share with a really great group of people similar to you. I mean, it's usually people who have gained wealth and they want to protect it. My whole strategy is all about how can we make the most money with the fewest trades with the lowest risk. And it's 100% about preserving capital, number one. And by doing that, we end up having great outperformance. We have about 2 to 3 times the performance of the buy and hold with a fraction of the risk. The buy and hold is like 40% potential losses multiple times. We're less than 6% because we actually manage and move away from volatility when needed. So very dramatically different strategy. So that's I'm big into real estate. I have multifamily properties. I have a self-storage facility I built. I invent stuff and patent and licensed product. I'm working on something new now that is a whole new sport, which I'm super excited with some scientists and some engineers. So I got my hands in all kinds of cool stuff. I'm part of a movie. We're just keynote speakers in the UK for Clean Tech and Summit show. So I just kind of put my hands into stuff that I love and find unique.
So I'm gonna play the recording this afternoon for my wife. We're about to take a little road trip, and I'm gonna play this for her, and she's gonna ask me why I didn't ask you what you're investing in now. So I'm gonna get in front of that.
Okay, well, so I've got a lot of cash sitting on hand. Really just in Canada here, it's a GIC. It's like a savings interest account type thing. I'm saving up for a lot of real estate. I think 2 or 3 years from now, there's going to be a nice real estate reevaluation event. So I'm excited to get into real estate, whether it's more self-storage or into multifamily or apartments. So right now, actually, if I was to share my screen, this key chart right here, this is what I think a lot of people need to notice now. What it is just showing a cycle of the markets and business as a whole. And more or less, we are kind of at the top of this cycle. There isn't a whole lot you can invest in. We're constantly looking, a whole bunch of us are like, where can we pull more money out? Where is there easy money? We are at this point of maximum financial risk. I don't care. There's not a whole lot left in real estate. The stock market is about to roll over and die. Bonds will have some upside if you get into bonds, if rates continue to fall. That could be the only really kind of good spot over the next maybe 12 months or so. But it won't be any huge returns or anything like that. So there isn't a whole lot to get in right now. I have a lot of physical metal. I love physical gold and silver. And I think we really need a financial reset. Really, it's going to clean the slate on a lot of stuff. It's going to wipe out prices in real estate, precious metals, commodities in general, stocks. Businesses are going to kind of reset as well. And if you can survive and hopefully thrive through that correction, then you're going to have like, more wealth, and you'll be like a kid in a candy store. You'll have all the money you want. There'll be businesses and toys and whatever you want to get into, you'll be able to buy at fair value or even undervalued. So it's all about right now, we're more so in preserving capital. Let's not lose any. We're still long the equities markets. They are still in a bull market. They are still going up. So that's where we're invested right now on the short-term basis. But again, this might not last very long. I think the elections are coming. I think by the end of this year, I think the stock market will probably be topping out and rolling over. And kind of that'll be the start of, I think, a much bigger correction and reset.
Yeah. So where are you going to go to wait that out?
So there's a couple things, like bonds are starting to come to life. If the stock market in general, you look at it, it's putting in a major top over the last several years when you look at a basket of stocks, removing the tech heavyweights. And when that one asset class is putting in a major top, there's usually another one like rising from the ashes, which happens to be bonds. So I think TLT, which is the long-term treasury bonds, I think it has some potential to rally 15, 20% over the next year or two. I think it's a good opportunity, kind of a somewhat low volatility play to the upside. The strategy that I use, we're trying to catch these kind of waves in the market. So overall, I think we'll be able to catch potentially 1, 2, or 3 nice rallies in the bond market and just catch the upside. And then from there, once we get into a stage 4, a full-on bear market, then we actually play an inverse ETF. So as the stock market falls, the ETF goes up in value. So it's pretty simple, just an inverse relationship. You do have to trade the markets very differently. The markets fall very quickly. Instead of an average trade lasting 40 days, like an average trade in a bear market is like 7 or 10 days. Like it just drops, hits our targets, and we're like, let's get out. We're good. That was our setup. We'll wait for it to reload and we'll get a new signal in a month or two. So that's how we go about taking advantage of a falling market.
Cool. So you get to take vacations?
I do. I take my laptop. I'm on my laptop here. So
Yeah.
the nice thing about the strategy that I have, we only have like 5 or 12 trades a year, right? And with my data, I can see trades coming like 4 or 5 days out. I also know when we're like weeks away from a trade. Like, for example, we were in cash a little while ago, a few weeks ago, and I told everybody, I'm like, listen, it's like the last couple of weeks of summer. We have no trade. Our strategy will not issue a trade for at least 2 or 3 weeks. Go have fun. And, watch my videos just to stay updated on the markets, but don't think anything's coming. Just go enjoy it. And that's what I love about the strategy. And I've evolved over time. I used to trade small cap stocks, penny stocks, options, Forex, futures, day trading, all that. I've come full circle to how do I just manage a large chunk of money safely and not have to like manage it and watch the screens all the time. So that's what's nice about this. We just put a position on when there is a major wave coming through. We see it coming days or a week in advance. We know it's about to end, and we're getting ready to exit the position once we have the technicals and position management trigger us to get out. So it's really nice. You can just take your laptop and go. And I have it automated, so I just turn on my screens. It tells me, what's going on. Makes it even easier.
Well, my wife is going to love it that I did this interview, and so I'm sure I'm going to hear about this a lot over the coming days. So we only have this limited time, and there's a lot more to. I literally could spend days. I'd like to just hang out and watch what you do, even if it's doing nothing, just watching your laptop. But how do people listening, I would say, including myself, how do we connect with you and get to plug into your brain?
Yeah, there's 2 ways. The first way is just go to my website, thetechnicaltraders.com. You can subscribe, start following, super educational. If you want to be in tune with the markets, the economy. Now, I'm an entrepreneur and I talk about this all the time, even with subscribers, is I talk about the business cycle. I talk about, I built a business when the last bull market started, when it was confirmed in like 2004, 2005. I built a healthcare business. I built a dealer network across Canada, United States, got my product seen on TV. And then I saw the music coming to an end, just like what we're starting to see now. And I sold my business in 2007, literally at the top. And like, then the world fell apart after that. So there's a lot of insight. The stuff I share, I mean, I share all kinds of stuff. Really, this newsletter, while I say it's for trading ETFs, like investing, it really is like a lifestyle kind of newsletter because I just share what's going on with real estate. We have a ton of real estate users. Most of the people I have are like entrepreneurs. They have their own businesses or practices, or they're advisors. And so it really helps kind of everybody relate with themselves or their clients more because they know the cycles we're in. But if you go to my YouTube channel and just type in Chris Vermeulen or The Technical Traders, you can watch some videos of what I provide. Some of the videos on there are what I give to subscribers. Usually I cut out the trades or any positions we have, but you'll see the type of analysis I do, and it's very high level. And I think most people grasp it. It'll make sense to anybody who has a bit of a logical mind. If you're generally an advisor or an attorney, you're probably pretty sharp and you like, structure and logic and how things flow. And that's how I work, is I'm that type of personality. I'm an INTJ, if you know the Myers-Briggs. Yep. So I'm, very focused on the fine details and structure. And I got my pilot's license when I was 16. It was all about checklists. Like, if you want to land not in a ball of fire, just follow that checklist, right? So that carried over into my trading. And, along the way, I blew up 3 trading accounts. One of them I blew up the same day I opened it, trading futures. That was when I turned a corner about risk management. That was the last account I blew up. That was back when I was in my 20s. And I've gone through a bankruptcy. I've been to the top and back down. And so now I realize, okay, it's all about preserving capital. And if you preserve your capital, then you preserve your lifestyle. And so I'm just at this point now, it's like, how do I grow my money, but never really risk it or my lifestyle? And that's just my core focus. And the reason I wrote this book with my partner, Ashley, and I'm trying to share kind of what I'm sharing with you today, is because I believe we're coming to that huge turning point in the market where the majority of retirees are going to get absolutely slaughtered when and if. It's just a matter of time when we have a big financial correction. It's not if, it's just when. And it's going to devastate people. And this whole strategy is like, allows us to totally step aside. Like during COVID, we did exceptionally well. Falling stock markets, we got out of it, moved into bonds. They rallied like 19% in 9 days. And then we moved to cash because nothing met our criteria. And we rode out COVID for another month in cash, worrying about only our health and our family and stuff, while everybody else had lost their shirts and were panicking financially and mentally and physically. And so this strategy is all about preserving your capital. And if something starts to go south, we close out the position and we can rest and let the dust settle.
So it's thetechnicaltraders.com.
Yeah.
Right. And is that the best way to find you?
It is. I mean, I'm on LinkedIn and YouTube. Those are the 2 best spots you can reach out there.
Terrific. So Chris Vermeulen, it's been a pleasure. It has been a great pleasure having this conversation with you today.
Yeah, well, thanks, Dan. It's always interesting to get someone else's take and of a different strategy, because it is very different than, the buy and hold.
Yep, for sure. Hey, thanks, man. I appreciate it.
You've been listening to the Legacy Leaders Podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.